Good morning and welcome to this Wednesday, January 11th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, after a pretty weak finish on Monday, we actually had a pretty decent day on Tuesday, which was good. Finishing near the highs of the day. S&P 500, which failed at 3,900, did manage yesterday to clear it, closed at 3,919. That's kind of been, I don't know, we've kind of been revolving around 3,900 throughout 2022 and into 2023. I mean, I can't even tell you how many times we've either held at that level as support on the way down or at resistance on the way back up. But after failing on Monday, it looked like we were poised in the short term anyway to turn back to the downside. We did at the open. I mean, we were down early yesterday, but then we rallied back, got back through 3,900, and now we're on the north side of that key level. We'll see whether or not that holds. I'll show you in a minute, but my target, or the number that I'm really watching on the S&P 500, is 4110. I think if we take out 4110, that's going to be pretty good indication that the lows in October are the ones that are going to, or is the one that will hold. But we'll see. We still have a lot of work to do to get there. Still a couple hundred points away. To the downside, the recent congestion, the gap support from back in November, I think it was November 10th, when we gapped up with the October CPI, that gap support on the S&P is somewhere down around 3750, 3760, somewhere in there. So we got a couple hundred points down to that level. We got a couple hundred points up to the 4100 level. We'll see what happens from there. Anyway, before I do get into all of that stuff, let me take those of you who are new to Earnings Beats over to our homepage. And I always just like to make sure everyone is aware. We get a lot of new people in here every day. And so if you are watching for the first time or just a few times, I would highly encourage you to take out our free newsletter. There's no credit card required. It's completely free. You just go to earningsbeats.com, scroll down, type in your name, email address, hit that subscribe button. 3 times a week, I'll issue a newsletter. So Mondays, Wednesdays, and Fridays, usually out around 8:30 in the morning. Sometimes I'm a little late. And so it'll come out just a little bit later, but we do try to get it out before the market opens. And there's a lot of different subjects that we may talk about. I talk a lot about earnings and relative strength, so that's a pretty common one. But I may just pull up an industry group. I may pull up a sentiment chart. There's a lot of different things I could pull up, but I think you'll find it very interesting, educational. And one other benefit of being on our Earnings Beats Digest newsletter is that when we have our free events, we reach out to everyone. So it's a way of making sure that you're aware every time we have a free event, our Earnings Beats Digest folks are invited. So anyway, go to earningsbeats.com, scroll down, make sure you get signed up. Again, it's free, no credit card required, and you can unsubscribe at any time. If you're not finding that it's helping you in any way, feel free. I mean, you know, we're building a community here, but we want folks who, you know, feel like you're getting something from Earnings Beats. All right, let's move on to the action from Tuesday. So the Dow Jones Industrial Average tacked on 186 points, S&P 500 27, the NASDAQ 107. So on a relative basis, there's your winner. Mid caps up 24, small caps up 15. Major indices now moving back through those moving averages. And what this tells me, you know, usually what I use moving averages for is, you know, as you trend higher, they're good support on the way down. Or if you're trending lower, they're good resistance on the way back up. But when you get into a trendless market, you'll see constant movements above and below the key moving averages. And I think that's a little bit where we are right now with the S&P. I mean, since we put in that low in October, we went through both moving averages, back beneath, back above, back beneath, back above, back beneath here, back above, back beneath, back above. And then literally Monday back above, and then yesterday, you know, after we had that strong reversal on Monday and finished below the 50-day moving average, and yesterday we come right back up and close above it again. So this is just like a poster child for indecision and trendless. market. Now, this is looking at the daily chart. Those of you that look at the weekly chart will say, well, this isn't trendless. We're trending lower. And I don't disagree with that. I think clearly we have been trending lower. We have a series of higher highs, higher lows, or excuse me, lower highs, lower lows. And we haven't been able to break the downtrend. So that's why I think if we get above that 4110 level, not only will we take out a couple of key resistance levels in terms of price action, but we'll also break that downtrend line. That downtrend line intersects right around 40.25 to 40.50, somewhere in there, depending on, exactly how you draw the trend line. There's a little judgment involved. Do you connect the highs, intraday highs? Do you connect the candle bodies? I mean, so there's going to be a little bit of little wiggle room in there, but I would say 4100, 4110. If you take out that price resistance, there's no doubt the trend line's been broken. So that's why I'm kind of watching that level to the upside. Looking at the sectors, you can see communication services had a good day yesterday, up 1.5%. And this is a group that was really bad for a long time. Nice little base forming here, triple top up at about 52. We could find our way through to about 52, 52.5. Things would start to look a lot better for communication services. And this is a group that houses the internet space. Internet loves the month of January. Communication services love the month of January, but it's primarily because of internet. Some of those large internet companies do very well in January. Facebook, or now Meta platforms. That's one company I know that does usually does extremely well in the month of January. So anyway, kind of watch that one, because that's been a group that's been really killing the bulls for the last year. Start to put a base in and get a breakout of a base. I mean, you can look at this and say we got a bottoming head and shoulder pattern. Left shoulder, neckline. There's your lower low for the head. Here's the right side of the neckline. Almost a perfectly symmetrical right shoulder. You come back up, you get through 52.5, and that's starting to paint a much more bullish picture in this sector. And this is one of the three aggressive sectors that have really held down the overall market, but especially the NASDAQ. So watch 52, 52.5. I think that's a big level. Discretionary stocks also up 1.25. They're starting to turn around. We've gotten back through the 20-day, which is step one. Still got a lot of work to do. All these tops up here around 147, 148. We're down at 134 and change. Clearly, we've got more work to do there. Materials, though, look like maybe the right side of a cup forming here off of an uptrend. Went back to that 50-day. Remember, we had the negative divergence on the higher prices. Talked about maybe material struggling for a bit. They did. But after struggling, now they're coming right back again. So cup there would be bullish. And obviously a breakout above that December high would be very bullish as well. Healthcare. So healthcare, also one of the, I think there were only, I think 10 of the 11 groups yesterday finished higher. I think Staples was the only one that finished lower. But anyway, healthcare was the fourth best group. Finished up more than 0.8%. It was looking like it was breaking down on Monday. So that move back was a very welcome move. And this pullback right here, even though we went below the 50-day, looks like it could be testing an area of support once we broke through that resistance. Of course, that's TA 101. Broken resistance becomes price support. And so that's what we're trying to hold on to here. But getting back through the moving averages would be key here for healthcare. And then, as I mentioned, Staples, the only group yesterday to be down. And it was just down a little bit more than 0.1%. Went back down to that to that PPO center line, starting to turn back up again. I think we're going to just see sideways consolidation, and ultimately we'll get a breakout, I believe, above that 77.5 area. So watch for that. All right, 10-year Treasury yield. Let's take a look there. Not a lot in terms of economic reports. I know the big one comes out tomorrow morning, and you definitely want to be aware of that. That will be your December CPI. The last two, October and November CPI, when they came out in November and December, both were lower than expected. Both resulted in a major gap up. I don't know what's going to happen tomorrow morning. I couldn't tell you. If it comes in a little bit hotter than expected, I do think you'll see what you would expect, which is a drop. I would think the market will gap down. But if it's only a little bit above I think that could be an opportunity. I think we'll probably see a gap down followed by some strength. And that's because the December CPI from a year ago, I believe was up around 0.5% or maybe 0.6. And so, and I think we're expecting 0.2 or 0.3. Let me see. I'm doing a lot of guessing here. So tomorrow, the CPI, the expectation is for, well, the headline number is expected to be flat. If you strip out food and energy, we're expected actually to rise 0.3%. So if we come in a little hotter than expected, let's say 0.4, or maybe even 0.5, let me, I think I had it in this market vision chart from last week, or from this chart list from last week. All right, so last December, yeah, we were at about 0.56 right here. So if we come out up higher than than what we're expecting, 0.3%, let's say we come in at 0.4 or 0.5 even, come in here, like in this range, it still is going to be less than a year ago. So we're going to see this drop potentially to a 1-year low on the annual core CPI. And I think over the next couple of months, because we have the December at 0.56, we've got January, which was in close to 0.60, and then February, which was above 0.5. And you can see we've been trending lower. If we stay somewhere down in this 0.2 to 0.4 range the next few months, this annual rate's going to continue to drop. I don't know what the media is going to do with it, because they're not going to be able to talk about 40-year highs anymore. Will they talk about 1-year lows? Because I think that's where we're heading. So anyway, I think inflation has topped. I think we're working our way back down. We haven't even had the benefit of all these interest rate hikes that the Fed has already put into play. And there are definitely signs of significant slowdown. I mean, factory orders back last Friday down 1.8% was rather jaw-dropping. The expectation was it was going to drop 0.8%. It dropped 1.8%. So there are definitely signs out there that things are slowing back down. The jobs market, not so much. We're seeing a lot of layoffs in technology, but we've got other areas that are picking up that still have shortages of employees. So I think it's just kind of like this rolling kind of a situation in terms of the job losses and, what areas are weak, what areas are stronger, and that sort of thing. But I think a lot of the job losses you're seeing, I don't know if you've been watching Salesforce.com. Salesforce.com a week ago or so announced they were having a big layoff. Stock's been going up ever since. This was all of this is building in the bad news. And then you get the bad news and the market starts to go up. The folks that have been in Salesforce.com are like, what the heck's going on with the company? Oh, they're laying off. It's bad. Better get out. Well, that's a lot of times when it's time to get in, because all of this is already building up for that bad news. That's the reason stocks go down. Wall Street knows what's coming 6 to 9 months down the road. For the most part, they're pretty good at it. And so they start selling and they get out of stocks that are going to be running into trouble, and they get into stocks that are going to be looking a lot better. So one thing that I'm watching, I don't know if you've been paying attention to this at all, but restaurants. We bottomed in May of last year. And let's go down here and put in the relative strength. All right. So down here's your relative strength. Look at restaurants. Since March of last year, money has been rotating into restaurants relative to the S&P. Now, again, you have to understand this is relative. Price action's going lower. So if I said, hey, relative strength bottomed in March, and you look at it and you say, no, restaurants went down until May or June. It's not what I'm saying. Yes, they went down, put in new lows, but they were outperforming the S&P. The S&P was dropping faster during April and May. and June. Remember, S&P went to a new low in June. We had those big drops. Restaurants never went below the May low. They were already showing relative strength. And look at this, it's just continued. Now I'm going to ask you a simple question. How bad is this recession going to be coming up if Wall Street thinks that they need to be jumping into restaurants? That's why I pay no attention to news and what everybody's telling us. You know, and I do these videos and I get these comments, well, yeah, but what about the big recession that's coming? You're way off base. All these stocks are dropping, blah, blah, blah. Maybe they will, but that's not the story I'm getting. Again, you can listen to the media. I'll listen to the charts and we'll see who comes out in the end. It's the way I follow it. I mean, I don't care what they're saying. I want to know what they're doing with their money. And this is how you can tell what's actually happening with their money. Remember, Wall Street, I mean, they're an unscrupulous kind of a crew. I mean, when you manage money for large clients, large wealthy clients, I mean, that's one side of their business. You know, Goldman Sachs has these clients, all of them have $1 million or more invested. You know, they got these wealthy clients. And then they've got their analysts that they send out to CNBC and other area, you know, everywhere, just telling the world what to do. You ever watch some of these analysts, you know, their price targets? Stock will be at 200. No, their price target will be 350. And then the stock drops down to 80. And then after that, they lower their price target down to 100. It's like, what about 350? What happened to 350? No, we're just changing our target. It's okay. And then the third part of these Wall Street firms, like Goldman Sachs, is that they got market making units. So when they're telling you on CNBC what a great stock this is, it's 200 and it's going to 350. Jump on board. We really like this one. And then while everybody sees that and starts buying, if there's more buyers than sellers, guess what happens? That same firm is on the other side of those trades selling to you, shorting. What a great system. Listen, it's the best system we have. I'm not saying that there's a better one out there, but you need to know how the system works. It's not designed for you and me. I mean, pay attention to the media at your own risk. That's completely up to you. But I don't trust anything that is said unless it's Warren Buffett. I'm probably not going to believe a whole lot of what I'm hearing because I just don't know what anyone's agenda is. You know, if you're an analyst from Goldman Sachs and you're coming in touting a stock, how about telling us what your net position is at your market making unit before? Anyway, all right, I'll be done. I go on these long rants. So anyway, I think restaurants look really good. I think on an absolute basis, you can obviously see that we've been trending higher for a long time. That's opposite what we've been seeing in the overall market. And as a result, there's your relative strength. And again, I'll just ask the question, if restaurants are doing so well and Wall Street wants to pour into restaurants, how bad is the recession going to be? Because if it's a deep recession, consumers don't spend money. They will stop. And one of the first things that gets cut out would be restaurants. That's purely discretionary money. You can eat at home. You can do TV dinners. That's a lot cheaper. You know, just go in the frozen food section, get a Salisbury steak. All right. I don't really like those. I'm just kidding. But my point is there are cheaper alternatives to going out and eating. There are a lot of folks that like to go out and eat all the time. The economy really starts to hit us hard. That's changing. And right now on the charts doesn't look like it's changing. All right. S&P 500. Here it is. There's that move back up above the 3,900 level. And I could draw a line in here, but I've done it so many times before. But just look at all the tops and bottoms right at 3,900. I mean, almost, this is obviously the one area where the market is just drawn to. And we went a little bit below 3,900. Then we went way above 3,900, way below 3,900, back a little bit above 3,900, a little below. And now we're sitting almost right at it. Which is it? Are we going to go back above eventually the 4,300 level? Or are we going below 3,500? My money is on 4,300. I think we're going up. I don't believe we're going back down below 35. Just my opinion. All right. As I look at the various industry groups, if you said, okay, Tom, what's the strongest industry group out there? Well, first thing I would ask is what time horizon are you talking about? Because this is 1 month. Obviously this is the worst. Automobiles over the last month has been by far the worst performing group. Doesn't mean automobiles are down 27%. It means they're down 27% relative to the S&P 500. Now they may actually be down 27% because it's been pretty bad. Hold on one second. Thanks. Just had to get some water. Still battling this cold, sinus infection, whatever. Everybody seems to have it, but anyway, it's really hard to shake these things. So autos, over the last month, worst performing group. And if you want to know over the last month, best performing group, you'd have to look into the energy space. So you got oil and the DJUSI. So if we pull it up, actually, I could just do it this way and just pull it up here. But if we pull it up, you can see there's your relative strength breaking out to a new high. If you look at just the absolute, oh, why my charts have gotten all screwed up here. Let's try this again. Down here at the bottom, if you look at the absolute price action, which is down here, you can see an actual breakout. All right. And this is one of those situations, look here, where the group on an absolute basis put in a new low, September versus July. But look at the relative strength. Money's actually still rotating into the group. And that can be a pretty important sign that you don't see by looking at the absolute price chart. You look at it and you think, I'm getting a breakdown. Well, you are in a sense, but the stock market is so weak. That's what's triggering it. It's not that the group itself is seeing money rotate out of it. Quite the contrary. We're actually seeing money rotate into it. So that's why it's so important to be looking at both. All right, so let's take a look at the relative strength here. And so again, if you ask me what's the best group, well, over 1 month, it's the exploration area of energy. How about if we go back 1 week? Well, now it's aluminum and non-ferrous metals and renewable energy. First Solar, big part of that, by the way. First Solar's had a huge week. How about 1 day? Well, I don't know that I would pay a whole lot of attention to 1 day, but there you are. These were the best groups yesterday. 3 of them were in materials. I showed you at the beginning, the right side of that cup. Materials really taking off here recently. 3 of the 4 best groups yesterday were in the materials area. So if you're trading in areas that are strong in the very near term, you're doing really well, obviously, or at least you have better odds of doing well. But again, that's just 1 day. I like going back typically over a quarter. I think a quarter gives us a pretty good idea because earnings are every quarter. So as we head into earnings season, I kind of like to know what the market, where's the market been putting it, or Wall Street, where's Wall Street been putting its money? The big Wall Street firms. Non-ferrous metals, footwear, Nike's been doing well, Crocs, Deckers. This area of real estate, I don't know that there's a whole lot of stocks in there from what I remember when I pulled up the index and looked at it. So I normally just scroll right past that one. Then you got aluminum, you got transportation services, another energy group, apparel retail. Tell you what, you look at this stock or this group, look at the relative strength here. Now, if you want to, okay, so let's say you're looking at the relative strength and you see this going up and you're like, well, that's great, but that's an index, Tom. I can't invest in that. What do I do? What do I do with this information? Well, you can see it started making pretty good move all the way back in September and October on a relative basis. But if you want to find some of the leaders, there's a couple of ways to do it. You could scan, but that's intimidating to a lot of folks, the scan engine. One thing you can do is just go into the scooter reports. So if you go to your dashboard, and over here on this left side, scroll down until you run into, I think it's under summary pages. And there's scooter reports. Just click on that. Okay, so here you go. Large cap stocks, it's in scooter order. Watch what happens when I type in apparel. There's your large, these are the 3 large cap apparel retailers in scooter order. All of them in the 90s, by the way. All 3 of these really performing well. So we could pull up Burlington. I mean, here, breakout was all the way back here. So if you noticed all the way back in September and October, that's when the relative strength started changing. And if you're following the group back then, I mean, look at this move that the stock has made. How about Ross Stores? Pretty similar. I mean, broke out all the way back in July, August above the moving averages, went sideways, but even through here, another nice breakout, and then the big gap up, continuing to move higher, very strong stock. And then TGX, which I think is one of the strongest stocks out there right now. Beautiful move up in October, November. Nice little kind of a cup, although we never really put in a handle, but we're still breaking out the new highs. So those are that's how you can go from a strong industry group to finding individual stocks. And you might say, well, I don't want the large cap. Well, go to mid cap. There's the apparel retailers, Buckle, Foot Locker, Signet, Gap, American Eagle Outfitters. Those are all in the top quartile, 75 and above with scooters. Or maybe you really want to roll the dice. Small cap apparel retailer, DXLG. What's that chart looking like? It's been pretty strong for a while. Look, broke out all the way back in August. Went back down near 50-day test there. There's a 50-day test. Then we went through a period of weakness, but we've come right back. Volume starting to pick back up again. It's been a very, very strong apparel retailer. All right. Let's go ahead, and it's 3 minutes till the market opens. Let's go ahead and take a look at 3 stocks for you. And I mentioned restaurants earlier, so I thought I'd stick with that theme. And I'm going to show you 3 restaurants performing really well. Look at the AD line here on Texas Roadhouse. Even as it was going sideways to down, look at the AD line breaking to new highs. We go to an all-time, or not all, well, maybe it's an all-time, but definitely 52-week high right here. AD line going right with it. Relative strength starting to turn back up. It's been a pretty decent performer. I think what you'll see with relative strength a lot of times is when a stock goes up and is leading, like this one was, when it consolidates, the group kept going up, but Texas Roadhouse was just consolidating gains. When it does that, sometimes it'll pull back. Now with the breakout, I wouldn't be surprised to see that relative strength continue to move higher again. Now there's no excuse. Now we've got a breakout. So this is the time when you would think more and more folks would move money into Texas Roadhouse. And so we would continue to see some leadership from that stock in the group. Next up, Darden, DRI. There's your move here over the last week and a half. Really big move. Look at the AD line on this one. Even down here, look at that red hollow candle with all that volume. Biggest volume of the year. We had a big gap down, and what happened? Everybody just came in and poured into it, bought it. Huge hollow candle. That's a lot of buying on that volume. Look at that pop in the AD line that day. When you get a huge candle like this on biggest volume of the year, you're going to see a big move up in the AD line. And then all of this volume is being added pretty much because we keep closing on the high. Really nice action in Darden. One other one, YUMC. This is Yum China. Also making breakout. Now, this one on an AD line basis doesn't look nearly as good to me. And this is secondary indicator. Most important thing is price. I mean, are you going to argue with a stock that's putting in a 52-week high relative to its peers? And its peers, the industry group, is one of the strongest right now. So you got a leading stock within a leading industry group, and it's been soaring the last 2.5 months relative to the group. Are you going to be upset and not trade it because of a bad AD line? I would still trade it. I would just be aware that, hey, if it starts to break down, I've got a poor AD line. I really don't want to be making excuses for it. But stock still looks good. All right, it is 9:30 now, right on the button. The 3 you must see out of the way. Let's just see if it'll give me the update real quick on what the market is doing. I don't know if that, I think that's yesterday, isn't it? No, there it is. So we're up over 33.8 today. So yeah, we got the Dow right now up about 0.4%. Same for the S&P. NASDAQ leading today, up 1%, full percentage point. So really nice day so far for the NASDAQ, at least getting started. We'll see what happens. One interesting thing though is we got the VIX moving up a little bit, not a lot, but we've got it moving up a little bit with the S&P up. We'll have to keep an eye on that because obviously that was one of the things I talked about. I don't know, maybe 3 or 4 days ago, I wrote an article. We'll come back and look at this in just a second, but I wrote an article. I think it was in my Trading Places blog. Yeah, this sentiment signal solid, says we could soar short term. I mean, I've been through it. We've seen it so many times. I point it out all the time. But anytime the S&P and the VIX over a period of time moves in the same direction, look at the correlation between the two. Above 0.25. It's only the third time in the last 3 years that we've seen it. First time we saw it, we had the S&P going up and the VIX going up at the same time. And when that happened, look what happened. We had a big drop. Look back in November of 2021. Again, S&P going up, VIX was starting to go up. What happened? S&P drops. This time it's the opposite. We actually had the market going down. S&P was going down. The VIX was coming down with it. That means potential reversal. What are we seeing? The S&P 500 moving up. It was at 38.69 just a few days ago. Now it's 39.36. That's 67 points. That's almost 2% in just the last few days since that signal was given. So these signals matter. They don't happen often, but you need to watch for them. When they do happen, they can give you some pretty good signals. All right, NASDAQ, after a big move up, now it's coming back down. Let's see what's going on with QQQ. We'll look at this, then we're going to end. I just want to see this versus the 10-year Treasury. All right, this doesn't look like it was ever up 1%. So I'm not that NASDAQ one that was showing up there may have been from yesterday. But anyway, let's take a look at the 10-year Treasury yield. Well, it's actually down a little bit today. I think this has been the confusing part for me personally, is that I think when the yield's going down, we should start to see relative strength in the NASDAQ. And that has not been the case over the last month or so. And I think part of it is, well, I'm really not quite sure exactly what it is, except that, I think the Fed, in my opinion, again, just my opinion, I think the Fed is botching some things more in terms of it's their transparency. It's what they're looking for. They say one thing and then they get it. And then they say, well, yeah, but we need a little bit more and then they get that. Well, yeah, but we got to do this. And I think the market, especially in those large cap growth names, they're built a lot on growth. And if the Fed, if they can't get clarity from the Fed on what they're looking for to really begin to bring those rates down, I think that could have an impact on what's going on with the NASDAQ. I'm not really sure, to be honest, though. But let's take a look here again at the Q. Yeah, it's coming back down near the flat line. Probably all of the major indices moving back down a little bit. So we'll see how it works out in the day, but still up around 0.4% down S&P, down about a quarter, or excuse me, up about a 0.25% on the S&P. Let me start this over. Dow and S&P up about 0.4%, NASDAQ up about a quarter. Anyway, that's it for me. Have a great day, everybody. And we'll be back tomorrow over at Stock Charts TV for your next Trading Places Live. Have a great day. Happy trading.